Hello and welcome on this edition of All About Your Company. We're going to be talking about Godawari Power and Ispat. Why is this one looking interesting is because when you're looking at the metals, the entire metals basket, it's been very resilient, and this one sits at that with a very large growth roadmap going forward. Really, what the stock has done is 56% in the last 12 months or so. So that's, of course, one of the pieces which is interesting. But when you're looking at just the top line guidance, the last year, FY26, broadly will end 6,000 crore or sub 6,000 crore. But what will really stand out is if they're able to do what they've said in terms of guidance. 12 to 15,000 crore by FY28 is what they've guided for. So very, very strong growth is what they're penciling in. So they'll double in terms of top line. 25,000 crore by FY30 is what their aspiration is in terms of top line. At 20,000 crore in terms of market cap, if they are to do that, of course, there will be considerable scope for re-rating even going forward. The stock is up over 50% in the last 12 months, of course, and around 90% in terms of returns in the last 6. We've not seen a correction all through March, April. I mean, we saw a bit of a blip over there. But after that, we've seen a very, very strong recovery on the stock price. So really resilient in this time as well. But let me quickly take a step back, look at the company and give you some perspective on what the company does. First, the overview. It's part of the Hira Group, incorporated in 1999, integrated steel and energy producer. It does iron and steel with captive mines now. And the captive mine ramp up will actually play out in FY27. And it's in the power and renewable space as well, including battery and energy storage, which will be a key lever over the next couple of years for the company. Now, that's just setting the context. Let me talk about the products. Starting off with iron ore mining. They extract ore for internal steel use or for the manufacture of steel. Then they do beneficiation, which is nothing but upgrade low-grade ore into richer concentrate. Thereafter, they do pellets. And we've spoken a couple of times on this show, if you followed it. Pellets are nothing but the raw material for the production of steel. So they do high-grade iron feed for sponge iron plants. They also obviously have forward integrated their entire process, and therefore what they also do is sponge iron, which is again a critical element towards the manufacture of steel. So sponge iron, and thereafter sponge iron is used to manufacture steel billets, and that's semi-finished steel for the purpose of rolling mills. Thereafter, they do structural steel, which is beams, sections of infra projects, and the like. They do mild steel rounds, which is long products for construction and engineering. They do hard bright wire, which is a drawn wire for fasteners and fabrication uses. They do ferroalloys, which is that they add alloy elements into molten steel to produce other products as well. They have galvanized fabricated products, corrosion protector, towers, structures, and the like. So they virtually work across the infrastructure ecosystem, and their products also go across it. They also, to try and leverage on cost control, they have captive power plants which produce low-cost electricity for in-house consumption. They also sell it to the grid as well whenever there is excess power. Non-ferrous recycling, which is recover metals from industrial scrap. They've purchased an associate now, or stake in an associate now called Jammu Pigments, which does that for them. They do battery and energy storage going forward, which is assembling large stationary battery containers. That's what they've gotten into. And the last piece is cold rolled complex, which is making high value coated steel sheets. So they, I mean, in terms of the product lines, they have a massive number of product lines clearly visible, and they've backward integrated it all the way till mining. And the mining too is going to get ramped up FY27. So a lot of this is going to start seeing the light of day over the next couple of years. Plus, they have a 2,000 crore CapEx plan as well. That's the way in which their sales are placed. So largely India facing. Exports is just 1 to 1.5%. The business model itself, they mine ore, they sell intermediate pellets, steel, and the like. Backward integration means lower costs. That's how they are playing it. How the process works: iron ore to pellets to sponge iron to steel billets. We've spoken about this broadly. but just quickly refreshing. They use power generated internally. How is power generated? Waste heat, coal, solar and biomass. That's broadly the way in which their power is generated. They then use steel billets plus alloys to build structures, and steel billets to containers for battery energy storage. They also do cold rolling complex. What all does it sell? Now this is crucial because they do so many things. A lot of it is for internal consumption, a lot of it is for external sales. So what all do they sell? Pellets, steel products, power, battery and energy storage containers, and cold roll products, and they also have a recycling associate, which is Jammu Pigments. I spoke a little bit about that. So broadly, this is the take. Now let's talk about the numbers. And essentially what we saw when you're looking at it 4 years back was that we are operating on an extremely high base because realizations at that time were very good. Thereafter, realizations have flattened, and in fact now realizations are actually under pressure. So the revenue CAGR is virtually zero over the last 3 years. This is why we've given it a thumbs down. But mind you, viewers, essentially the way to look at this is forward looking, that what is the company going to do over the next 2 years and what's the confidence it demonstrates. And we will speak with Abhishek Agrawal to try and understand as to whether this turns around sharp and quick, and how quickly, and what are the levers. We'll talk about that. But for the moment, last 3 years, this is what the numbers look. In terms of the EBITDA numbers, you'll see that there's been a fall because realizations have compressed. In fact, FY26 also looks difficult because their pellet plant had temporarily shut down, and you also had concerns with regard to realization. So FY26 numbers are in fact even more difficult. But you've seen a compression with regard to EBITDA as well as margins, and profitability also has shrunk versus the FY22 base. Mind you, 20,000 crore in terms of market cap, just to kind of contextualize some of these numbers. Now, let me look at the 9-month FY25 to 26 figures. There you go. -4% on revenue. So while volumes have gone up, revenues come down because realizations have compressed revenue. EBITDA has come in lower by 8%. That's visible. Even despite that, your margins are maintained at above 20%. The net profit has shrunk by around 12% on a YOY basis in the 9-month period FY26. The question is the worst behind us? Really, that's the question we're going to put across. In terms of margin trajectory, and when you're looking at it, you'll see that we saw a shrink in FY23 of the very high base of FY22. Thereafter, margins have rebounded and stayed above the 20% band. So that's on the margin trajectory. We remain neutral on this. Some of the segments that they are planning to foray into may have lower margins as well. We'll try and discuss that as well with Abhishek when he joins us in just a few minutes. Look at the balance sheet now, and this is where you'll start to see the resilience show up. There's no borrowing on the balance sheet. There's a 5,000 crore book value, and there's a 20,000 crore market cap that you're speaking about, and there's cash. 700 crore of cash is sitting in the balance sheet at the end of H1 FY26. We don't have the full year FY26 numbers, and therefore we don't have that updated. But broadly, that's the way it's playing out. You look at the cash flow conversion is fairly steady. You're seeing that on the cash flows as well, so no concerns at all there. They're net cash flow positive. There's a 2,000 crore CapEx plan, mind you, viewers, and that is something we need to look out for. They already sit on 700 crore of cash as we speak, and they generate around 1,000 crore of free cash flow, operating cash flow at this point as well. So that's something, again, to contextualize. You look at the return ratios, and return ratios have come off sharply from those highs of FY21-22, but nonetheless, they're above 25%. So nearly 23 to 25% is the kind of ROCs that this company has been clocking. Clearly a positive. That is an impressive number. You're looking at shareholding pattern, and within that shareholding pattern, you'll see that promoters hold around 60 to 65% share, and they have undertaken buybacks in the past as well. So that is something you want to take note of. But broadly, that's the way in which the promoter ownership is currently structured. No concerns. You've got FIs, DIs participating. You have the public holding around a quarter of the company. Now, the valuations, and this is where it starts to get interesting because you start to forecast how this company will likely perform. So currently trades at 27 times earnings at this point. It's the highest point in terms of PE in the last 5 years. The stock is up 56% in the last 12 months. The FY28 revenue is around 12 to 15,000 crore. Now, we might see a margin shrink because they're doing different products, and therefore you might see margin shrink. And if that were to happen, you'll have approximately, we've just taken a blended margin of around 18% as the number, in which case your price to earnings for FY28 shrinks to sub 15 times, which is the 5-year average for the company. So if everything were to play out well till FY28, you'll see a very sharp shrink, and thereafter you will start to see value starting to accrue, because at 25,000 crore, if the margins are 15 to 18%, the numbers could be vastly different. And that's what we're going to try to contextualize as part of this conversation. Let me bring on board Abhishek Agrawal, Executive Director at Godavari Power, joining us this afternoon. Abhishek, always good talking to you. So thank you so much for coming in. Let me first start off, Abhishek, with the key question with regard to realizations. I think that's what everyone wants to know. What's playing out and how are realizations shaping up for you?
Very good afternoon, Harsh. Current realization margins remains at the same levels from past 3 months. Margins were on the lower side in Q3, but starting of Q4, the margins have picked up. Even the realization is picked up, and there is some effect of war as well. So current margins are almost 10% higher compared to Q3.
Okay. Current margins are 10% higher compared to Q3. Understood. Give us a sense, Abhishek, what's playing out on the top line going forward. So you've guided for around 12 to 15,000 crore of top line by FY28. That's what the goal currently seems to be. Break that up for us, firstly, for the viewers, for better perspective. You've guided 5 to 6,000 battery energy storage, which is nearly zero at this point. 6.5 to 7,000 crore in steel and 2,000 crore in cold roll. Is that the right breakup? And how is it all likely to play out? Give us a sense.
So if you see current top line, it's about 5,500 crores from last 3 years. There has been no volume growth, but in Q4 we have commissioned a new pellet plant of 2 million tons. So going forward in FY27, our top line should be somewhere about 6,500 crores. Straight away, the top line goes up by the pellet volume added in the market. Parallelly, the battery storage project, which is under construction, should be up and about by end of Q4 or early Q1 of next financial year. So we see a top line about 5,000 crores from FY28 from the battery storage project. So at 5,000 currently, we do about 12,000 crores. And the CRM complex, which is again under construction, should be in operation by end of Q4. So from FY27, even at a 50% capacity, we see a top line about 1,000 crores. So from FY28, we would see a top line of about 12,000 crores.
So FY27 top line is around 7,500, FY28 top line around 12,000 crore. Am I right in the way I'm...
Yes.
Okay. And what happens to margins? Because my understanding is that on the BESS, which is battery energy storage, margins are lower.
Very correct. So on battery storage, we envisage margins about 5 to 7% on annual basis. Similar on the CRM line. On CRM as well, it's a high value added steel. The margin should be about 8 to 10% on CRM as well.
But that is gross, right? Or is my understanding wrong? Is it EBITDA margin that you're talking about? Is it gross margin on CRM?
No, I'm talking about the EBITDA margins for battery storage as well as the CRM.
Understood. So I'm just doing rough math as we're speaking. If CRM were to do 5,000 crore in terms of top line, if battery energy storage were to do 5,000 crore in terms of top line, that'll add around 350 crore in terms of EBITDA to your current EBITDA. You're already doing 20% on your 6,500, which takes your EBITDA to around 1,300 crore. And thereafter, you do another 350 crore from battery energy storage. And then from CRM, you'll do another 100 crore, right? Is that the right way to think of it?
More or less, but important thing you missed is a new pellet plant which got commissioned. So we should be able to operate at 80% capacity this financial year. And with my mining capacity going up from 3 million to 6.3 million tons. So in this financial year, FY27, we should be able to reach about 80% capacity of our expansion. And FY28, we should be able to produce 100% capacity for mining expansion. So there'll be additional EBITDA or margins coming in from the new pellet plant and the additional mining capacity.
Okay, and how much does that add? So the additional mining capacity, let me come to that. How much does that add to your current margins? Because I'm sure it's margin accretive, right? You using your own raw material.
Correct.
So how much does that add to your margin, therefore?
So about 25% on the pellet side. So with additional volume, that additional EBITDA will come from FY27.
Okay. And you're already at 20 to 25. So you're saying that you'll inch towards the 25% mark. Is that the right way to think of it?
Yes, very correct. So additional volume will also cater to my additional new pellet plant. So basically the margins will be on the similar levels from the pellet plant and the mining. Only the volume guidance will go up due to addition of the new pellet and the new mining capacity.
Got it. And therefore, you should do roughly 1,500 to 2,000 crore of EBITDA in FY27 alone. Am I right? So FY27 is going to be the standout year for you, the way I'm looking at it.
See, it's difficult where the market is going to go. After all, it's a commodity market and it's the war going on.
Absolutely.
But we are confident we should be able to maintain our current margins and the volume guidance given for the next year. We should be able to, do an outperforming year for FY27 compared to the previous years.
Makes sense. That makes sense. And you're saying realizations are also holding up. So while you're saying that, of course, there's that huge caveat that it's a commodity play. But at the same time, with realizations holding up, things are looking good. Is that the way one looks at it from an industry perspective? I'm not speaking from Godawari's perspective, but from an industry perspective.
See, at the moment, demand is good because this is the dry season. Going forward in Q2, the demand goes down because of the monsoon, and then in Q3 is full of festivals. So usually for steel, Q4 and Q1 has always been good. Plus, this war going on has also added pressure on the steel prices. So I believe going forward, next 3-4 months should be good for the industry overall.
You've guided 25% or you've not guided 25%, but you're saying that margins will inch towards 25%, including the kind of realizations that you're seeing. Give us a sense. You also have captive power and a lot of those projects coming on stream as well. Does the margin increase account for that as well, or is this purely from raw material?
No, so see, I think the 25% margin should be overall. So we have been doing, energy efficient projects every year now and then. So that is helping us to reduce our power cost, which is used for our captive consumption in steel making. So, but these projects, the net addition to the margins is not substantial compared to the margins addition from the mining and the pellet plant.
Okay, understood. With regard to, when I'm looking at broadly your CapEx guidance, which is 2,000 crore, you've got around 700 crore of cash sitting in your balance sheet right now. Maybe a little bit more, given that you've done one half of a year post the numbers that I have seen. Does entirely the 2,000 crore come from internal accruals? Is that the right way to think of it? Because you're capable of that. So I'm just trying to understand whether there's any bank funding required.
See, for the expansion in mining, for the pellets, and we haven't taken any kind of bank loan. Even for the CRM, we haven't taken any, for a bank loan. For the battery storage, because it's a different company, it's subsidiary of Godavari, we will intend to, raise some money there. But depending on the cash flow this financial year, there's a possibility we might not raise any money for the battery storage as well. So at the moment, whatever CapEx is being happening at the company level, all is being funded by the internal accruals.
And battery storage, let me talk a little bit about that. So what's the kind of CapEx for battery storage? I didn't find that. You had 2,000 crore overall is what you've said. 600 to 700 crore every year for the next 3 years is the guidance. But battery storage in particular, how much is that number?
So the battery storage for the first phase, which is 20 gigawatt, the CapEx we envisage is about 1,200 crores.
Okay. Oh, that's large. Also, give me a sense. Yeah, that's large. Give me a sense. When I'm looking at your timelines for the various projects that you're looking to complete, you've spoken about that. How likely are you to stick to those timelines? Do you believe that you can do that, or is that a risk?
No, see, we are very confident. The battery storage, the CRM complex, all are underway. There can be a delay of, 1 month, 2 months here and there, depending on the final execution. But apart from that, I don't see any challenge. Why can't we should be able to complete all the projects within time.
And Jammu Pigments, how does that add up to your overall kind of strategy in terms of growth?
See, at the moment, Jammu Pigment is we are associate company where we hold about 43% stake. Given an option where we can go up to 60-65% going forward. So with this acquired this plant 2 years back, the entire project is still under consolidation. Things have been improving. The volumes have been improving quarter and quarter. And I think from FY28, we should be able to, start declaring numbers for Jammu Pigment as well.
But tell me, Abhishek, you're doing such a large capex. I mean, I know you're 20,000 crore in market cap, but 2,000 crore for you is certainly large over the next 3 years. What's in the pipeline thereafter? Because you're generating cash at a far superior rate. So I'm trying to understand what thereafter.
See, for the battery storage, we have already announced this is the phase 1. We intend to go for the phase 2 as well. It's a very high-tech industry, which is ever evolving. So you have to be, with the technology. So depending on how we progress, how we establish ourselves in the market, we intend to have the phase 2 as well. And recently, we also announced a 1 million steel plant, which is a greenfield project, where we've already got the desired approvals. The evaluation is under progress. We should be able to start placing orders for the machineries in next couple of months. And the idea is to start the groundwork by end of Q3. Okay.
And with regard to, your CapEx, because it's so large and because traditionally, when I was pulling out the last 5-year ROCs, and team, if we can do that, you've done 20% plus all throughout. Do you believe that you can go back above 25% with all of the CapEx that you're doing? Is that the goal? Or will temporarily ROCs dip a bit before they rebound? Give us a sense of that trajectory.
See, if you understand, right, the future top line is going to come in from battery storage, where the margins are on the lower side. Same is for the CRM complex. So the top line will go up, from 5,000 to say 12,000. But the margins overall will come down from 20-25% to probably say 15%, because it's a low margin business, but the top line is going to be much more. So you have to look at the overall performance in terms of the top line increment and in terms of the margins going down.
Yeah, so exactly what I wanted to ask you. So on battery energy storage, you're doing a 1,200 crore capex. This will bring you around 5,000 crore of top line at a 5 to 7% EBITDA. I'm just trying to understand. The ROC will therefore dip, right?
See, it will. So see, the 5,000 top line will be only on the first year, where against 20 gigawatt, we should be able to achieve 40%, that is 8 gigawatt. But from second year, the capacity will be ramped up to 70%, and the third year, 80%. So at full capacity, 80%, the top line should be somewhere about 16,000 crores, only from the battery storage.
And at a 5-7% margin, and that's how you're saying that you'll still do decently double-digit kind of ROCs on that business. Is that? Sorry, please tell me if I'm getting something wrong here.
Oh, you have to be right.
It always helps.
It will still be a double-digit ROC business. The top line will keep going up as we establish our lines and increase our capacity.
Understood. And therefore at 15,000 crore odd of top line at maybe 5 to 7% margin. Understood. Okay. Thank you so much, Abhishek. This has been absolute pleasure. And thank you. You're always confident. You're always candid. Wishing you all the very best.
Thank you so much. Thank you for having me.
Okay. And viewers, that's all the time we have on this edition of All About Your Company. Thanks so much for tuning in.